America's largest bank warns of investment crisis. 2025. Bank of America is one of America's largest banks, and its investment division has released an article breaking down the reasons why growth and technology AI stocks and SP 500 index companies are in a bubble today, which they even liken to an even bigger bubble than the dot-com bubble that was around 2000 and the Nifty 50 bubble and crisis over 65 years ago. In both of those cases, the stock market was down tens of percent, and Bank of America says the SP 500 could be down as much as 40% by 2025. So together, let's look at the information the bank is presenting and put it in context to see if we as investors are really in trouble. Personally, of course, I'm interested too. I've been investing for over 10 years myself, and my public equity portfolio here is worth over 20 million Czech koruna according to Monera. And I've seen an appreciation of almost 30% in the last year alone. Let's see how bad it really is for us. Welcome to another investment video. So Bank of America says growth stocks are in a mega bubble. For complete beginners, it's probably worth mentioning that companies and their stocks are unofficially divided into growth, value, and possibly dividend stocks. Whereby value companies, think of Coca-Cola and its stock, are by definition usually more mature companies that tend to be more stable and generally grow slower than growth companies, which are more volatile but also deliver higher growth and can also deliver risk. Here we can include Google, for example. I have to admit that crisis warnings are common. In the US, there are portfolio managers who have been warning about the crisis for the last 10 years, like Michael Burry or Jeremy Grantham. You know, if you warn about crises for 10 years, you'll get it right one day. The problem is that in the meantime, you often miss hundreds of percent in profits. However, having one of the 4 biggest banks in the world warning about a crisis is not that common. As a bank, you have a lot of data that the average investor doesn't. Personally, I have millions of crowns invested in my public portfolio in the very growth companies that Bank of America is now warning about. Just looking at the Monera here, I see Google, Microsoft, Porsche, etc. Then I wonder what Bank of America is saying. According to it, investors are now stuffing money into growth stocks, and the market is starting to resemble the Nifty 50 bubble that was here over 65 years ago, or the dot-com bubble. And while it says stocks may continue to rise for some time, trouble may come. The bank's first argument is this chart. This chart shows the ratio of the market capitalization of U.S. stocks to the global stock market in USD. It basically measures how much of the global stock market is accounted for by U.S. stocks. 2 significant historical bubbles are marked on the chart. The Nifty 50 bubble, 1970s. Back then, U.S. stock market dominance was higher than average, but still relatively mild. Internet bubble, late 1990s, early 2000s. Another increase in U.S. stock dominance here as well. Current situation, Magnificent 7. Now the ratio is at its highest level in 75 years. This is mainly due to the large growth of tech giants like Apple, Microsoft, Nvidia, Amazon, etc. The Magnificent 7. The U.S. market is now significantly larger than the rest of the world. Going further, the 5 largest U.S. companies, starting with Apple, now make up 26.4% of the entire S&P 500 index. We can see that during the dot-com bubble, for example, which some of us may still remember, it was 18.2%. So the U.S. market today is very concentrated in a few stocks. Next, the charts are compared. This chart shows the share of the new economy in the total market capitalization of the S&P 500 index. And again, we compare the 2 big bubbles, what concentration there was. The new wave of AI dominance of technology stocks, now at a record 53% of the S&P 500 index. You can see we're really in the middle of an artificial intelligence boom. And the latest chart from Bank of America shows that after both of our familiar bubbles burst, the market was basically flat or dead. It was almost a lost decade for several years. And even though you can make money in a lost decade in the markets with, say, OPCI, I talked about it in this video in the community, check it out there. So, of course, it's not a pleasant event. All in all, Bank of America argues a lot that big U.S. tech companies make up a large part of the market, and whenever that has been the case in the past, most recently 65 plus years ago, it has not meant good things. Fund managers are now fully invested. They hold 3.5% cash, which is the lowest level in 15 years. 80% of respondents said they don't expect a recession, and they asked over 200 portfolio managers. 2 years ago, it was just the opposite. Almost everyone expected a recession that didn't come, so you can see how much you can trust the pros. If you look at this chart, companies are currently making record buybacks, that is, buying back their own stock from the stock market. Companies are doing this mostly because it increases value for their existing shareholders, so there are fewer shares of their company outstanding, and thus they are more scarce, and earnings per share are higher. In general, this is a good thing. It's just that if you notice, companies usually made record buybacks when the market was high and stocks were expensive, whereas in the 2008 and around 2000 downturns, buybacks were record low, which is the exact opposite of what you might expect. In fact, the ideal situation is to issue new shares when the stock price is high and buy back your own shares as a company from the stock market when the market is low. Yes, big tech companies are doing well today. However, let's look at why. When we look at the earnings growth of these firms, we find that in 2024, the earnings of these firms grew 6 times faster than the median of S&P 500 firms. In 2023, it was even almost 12 times faster. And this year, big tech is expected to grow 8 percentage points faster than the median S&P 500. So in other words, tech firms are so big today, also because they simply have no competition. They are simply extremely profitable and better than the average S&P 500 firm. Their growth and dominance is thus justified to some extent. My aim is not to scare you. Honestly, there is always something to be scared of in the markets. I always think of this chart of the S&P 500 where you can see every reason for selling over the years, and in the end you can see that despite all this, the index has been rising for a long time. And while I often agree with the charts and the bank's arguments, I'm still invested in the market and will continue to be. What is happening now was described by Buffett a long time ago. Stock markets do work in cycles. Video 1. The markets can be irrational for a long time and they can still rise for a year, 2, 3. Before a correction comes, no one knows when it will. If you were scared 2 years ago and didn't invest, you would have lost about 50% or more growth on your money. There is no point in waiting for a crisis. We don't know when it will come. We don't know how deep it will be, and we don't know when it will end. A smart investor knows what he owns, and if his company is overvalued in PE and other metrics and the fundamentals don't match it, he can sell. A beautiful example is Palantir. You know, it's my heartthrob. I've done maybe 4 videos on that stock. Anyway, when it became extremely overvalued with a PE over 400, I sold. Now is the perfect time for you. Check your portfolio tracker for your stocks. See how balanced your portfolio is. Check XTB and your positions to see if there is anything worth selling when we are in a rising cycle. Next, make sure that what you own you really want to own. Even if the price of that particular stock drops by, say, 30%, you'll still be okay with it. If so, great, you have a healthy portfolio. And for those of you who still don't have one and are bothered that you are missing out on investment opportunities and your money isn't making any money, join my investment community where there are now over 6,000 active profitable investors who are putting their money to work for them. There you will find all the videos and articles you need for your investing. Plan my profitable 20-plus mile portfolio, where I put all the buys and sells as soon as I make them. Link is in the description, yeah, and if you're wondering what the best super investors want to make money on today, check out this video. Take care.